The Federal Reserve met last week and delivered another 25 basis point rate cut at their December FOMC meeting. But this decision was not unanimous. There were actually 3 dissenting votes. There was one individual within the Fed who wanted the Fed to cut more, and there were 2 that actually thought that the Fed shouldn't cut at all. This was actually the first time since 2019 that we've seen 3 dissents at a Fed meeting. If we look at the broader group of FOMC participants, there are 19 individuals, only 12 of whom actually get a vote, but there are 19 individuals, there's 12 regional bank presidents, and there are 7 Fed governors. So of those 19, we actually saw that 7 thought that the Fed shouldn't be cutting rates at all at their December meeting. So this is what a lot of people are referring to as these silent dissents. Only 3 of those 7 were actually voting members, but we see that others who were able to share their opinion in one way or another actually thought that they didn't need to cut rates at all in this most recent meeting. I think that speaks to this difficulty of navigating policy in the current environment. And actually, Jerome Powell, in his press conference that followed the FOMC meeting, said that the Fed only has one tool, and they have to decide which battle they're going to fight. They can't manage the jobs market where we're seeing a deteriorating labor market and elevated inflation with the same tool. So they have to choose one or the other. And so these dissents are really a reflection of some at the Fed who think that inflation is the bigger problem, and others who think that fighting the rising employment rate is the greater issue. So these are things that we're going to continue to watch here in the months to come. It's certainly going to be interesting looking ahead, because we know that Jerome Powell only has 3 meetings left as Fed chair before his term expires in May, and we're all waiting to see who President Trump will nominate as the next Fed chair. If you look at market pricing, they're pricing in 2 rate cuts in 2026, even though those at the Fed are actually suggesting that 1 rate cut might be more appropriate. And 7 within the Fed actually think that no rate cuts are needed next year. So this is really going to be an interesting time and challenging time for the Fed and those of us that watch and plan investment strategy based on the monetary policy outlook. But I think it's really interesting to just take a step back and look at some of the data. Now that we've seen rate cuts actually reach 175 basis points. So that's 1.75% since the Fed started cutting rates back in September of last year. And what's interesting to me is that, contrary to what many might expect, we've actually seen that credit card rates, auto loan rates, mortgage rates, they haven't come down. In some cases, they've actually gone up. That if you look at the 10-year Treasury yield, it's actually a little bit higher than where it was when the Fed started cutting rates September of last year. And so I think this is really important. It speaks to the fact that inflation is still an issue, and the economy is still in pretty good shape. We've seen the odds of a recession have really fallen, certainly since the highs that we saw back in April, post-Liberation Day. So this is, I think this speaks to the fact that inflation, there's still some pressure out there, and that's why the Fed is having trouble forming consensus here in this environment, and why opinions do vary. So it's something that's very, very interesting. Obviously, we know that all these Fed cuts have supported risk assets, specifically the stock market, in recent months, and so that is one beneficiary. But we know that other parts of the economy, such as housing, is continuing to see weakness, and we know that President Trump has been referencing the weakness in the real estate market and broader housing market in arguing for more cuts at the Fed. But all evidence, certainly the most recent data, suggests that Fed cuts just really aren't making a huge difference there. So as we look to this week, it's going to be a really important week for economic data. We're getting 2 jobs reports. So the jobs report for October and for November. as well as 2 inflation reports. So even though it's going to be partial reports, we're going to get the inflation report for the month of October and for the month of November later on this week. We're getting 2 at once because we know that the government was shut down. And so we're starting to see a thaw in this data now that things aren't frozen. We're starting to see a little bit of drip of more information here as we get caught up here and brought up to speed on what's been going on with the market. So this is really going to be an interesting time as we look for the latest information about how the economy is doing, specifically as it relates to the jobs market and inflation, since we know that that is so critical to what the Fed is trying to accomplish here. So I'll leave it there for right now. If you have any questions, please don't hesitate to reach out to your advisor. I'll look forward to talking again soon.